This is a 25 marker past paper question from paper 3 Edexcel. It covers high rates of inflation in African countries. So we're going to talk about stuff like rising costs for business. We're going to talk about the effects on the balance of trade and productivity in an economy. We're going to talk about developmental economics. As always, I suggest that you have a read of the question, come up with your own answers, and then come back and see what I write to get a sense of how your answers match up with what I'm writing. So the question reads, evaluate the likely microeconomic and macroeconomic effects of relatively high inflation rates in many African countries. It's really important that you pay attention to the fact that this is microeconomic and macroeconomic effects, meaning that we are not looking at the causes of inflation in this case, nor are we looking at ways that we could solve inflation. We're just looking about what inflation does to businesses and to the economy and to consumers in these African countries. And I've just taken some key pieces of information from the extracts that I'm going to use as my application, so you can see them here and don't necessarily have to read the extracts for yourself. So we can see sort of central bank rate for Congo, Mozambique, and Ghana, and also the inflation rate for those three countries. Both rates quite high. This is not hyperinflation, but I guess you could make the argument there's some risk of hyperinflation if inflation cannot come under control. We're also told that Mozambique has weak foreign currency inflows because it has low demand for its export and a weak manufacturing sector that only employs 3.2% of people in the country. We're also told that sub-Saharan African countries raised debt levels of £20 billion, meaning they borrowed £20 billion together during the commodity boom of the early 2010s. So they're making lots of money, decided to borrow lots of money as well, and now those commodity prices have fallen and they are stuck with a potentially unsustainable level of debt. As always with these 25 markers on paper 3, I do tend to do a microeconomic point and a macroeconomic point just to make sure I'm covering my bases. So my microeconomic point is going to be this focus on rising, I wrote wage costs, I'm just going to do rising costs for businesses. We'll talk about wages, but we'll talk about other costs as well. And for topic B, I'm going to focus on a macro point, which is a decrease in export competitiveness. We're going to probably color outside the lines a little bit with this topic, talk about some other things that interact with it as well, but that's going to be the main focus. Starting with this microeconomics argument, I'm definitely, for the definitions, going to be interested in maybe differentiating between things like fixed costs, variable costs. I might look at maybe long-run average costs versus short-run average costs. So looking at how businesses make different decisions at different stages of growth. For the application, I am interested in maybe just referencing these inflation points, like just the actual levels of inflation in this initial piece of application. I'm actually not interested in the central bank rate just yet. I'm going to get onto that in my macroeconomics point. So for now, I'm just going to point out these three high levels of inflation. The rest of this feels, maybe I could do a bit of context for Mozambique and say that we've got like not that much manufacturing. So maybe we're talking mostly about sort of small scale businesses. I might add that in as context as well. For the diagram, I am going to go just for a fairly standard cost and revenue diagram, and I'm going to show rising average costs and rising marginal costs along with inflation and how that squeezes the profit margins of businesses. So in terms of breaking down why costs increase for businesses when we have inflation, I might just say like inflation tends to drive up prices for raw materials. In terms of bulking out the explanation for this, this might be partly because firms may be competing with one another for raw materials. If we have demand pull inflation, seeping a little bit into the macro, but that's okay. This is a blended topic. Alternatively, cost push inflation, we might just have a commodity shock, right? We might have a price shock if this is cost push inflation. So in either case, we would expect those costs of raw materials, which are going to be variable costs for business, so I want to classify them in that way, to increase. I might also say that Inflation also drives workers to demand higher wages. They're in a strong bargaining position because often there's a labor shortage around inflation. Again, we're kind of making some assumptions about why there might be inflation, and therefore that we might be in an environment where we have a low level of unemployment. You could use a Phillips curve if you want here. I'm not getting anything from the extract that's explicitly making me think this is sort of low unemployment driven inflation primarily, but I would expect that there are going to be demands for higher wages. So I'm going to say they may be in a strong position if unemployment is low. And this is going to drive up variable costs for business. Note that wages, sort of per unit or per output wages, which I suspect are going to be more common in these kinds of developing industrial contexts, those are going to be variable costs. Salary would be a fixed cost. So if you're paying someone the same amount every year, kind of regardless of their output, that's a fixed cost. So I'm going to label these as variable costs. I might want to make that distinction clear. And then I will say this reduces profit margins, may force lower levels of output in order to keep the most efficient point of AC. So we're going to be kind of compelled more and more to be in that sort of lower range of average cost in order for me to be able to make a profit or break even as a business. So that's going to give me a lot less control as a business over my level of output. And this, I think, would be primarily the analysis, right? We're going to like hinder businesses' profit margins. Maybe this decreases investment from businesses into things like research and development. And then in terms of the evaluation here, I might point out that willingness to push costs of raw materials onto consumers may depend on price elasticity of demand. So if we have highly elastic price elasticity of demand, firms are probably not going to be willing to put up prices for consumers, so they may end up squeezing the profits more. However, if they're in a more inelastic market, that might be more of a consumer burden. So I think that would be maybe a good point of evaluation for just assessing how this falls out. I think you could also talk about wages may not increase. There is likely a high level of unemployment given the developing context. Or at least high rates of informal employment. Right, so that maybe suggests workers are actually not in that strong negotiating position. Maybe wages don't come up. For the macro context, I'm going to be talking about how this creates a decrease in export competitiveness. And I might be defining things like exchange rates. I might be defining maybe price competitiveness. Balance of payments, maybe. We're going to talk a bit about currency. The application here, I am going to talk about that bank rate. So I'm going to do that. I might talk about, I'm going to bring both of these in because I want to talk about the bank rate here. And this diagram that I'm showing is specific to the currency. So I'm going to make an argument about currency. I don't think there's like a super clear diagram for the kind of export competitiveness argument I'm going to make, but I will make the argument that the loss of exports is going to reduce demand for the currency, which is actually the opposite of what this specific diagram shows, and therefore we're probably going to get a fall in our exchange rate. So the analysis here is to say rising costs of production due to inflation, due to reduced price competitiveness. This is especially problematic given the weak manufacturing sector, likely does not have major economies of scale. This in turn is going to reduce should reduce the exchange rate as demand for currency falls due to loss of exports. Falling exports may reduce the level of FDI in the economy. So sort of because we have high prices, we're expecting that there are going to be there's going to be a big fall in exports, a big fall in price competitiveness, and as a result, falling exports in the economy. I might also say, this is kind of somewhat related, high central bank rate, a corollary. So what I mean here is a corollary of high inflation, see extract data. So the reason it's a corollary is central banks respond to inflation by putting up interest rates. This is going to hits AD in the economy, and this will hit growth. So this is compounding the loss of exports to reduce AD. So actually we could do the ADAS diagram for this as well, but this is kind of a chunky argument, but this is probably what I would be arguing. And then for evaluation, I would say falling exchange rate may compensate for rising costs of production and restore price competitiveness. So basically we're saying, well, as our exports fall, we're going to get falling value for our currency, and so maybe that's going to offset some of that loss in price competitiveness that came from the rising costs of production, from the rising costs of those raw materials. And also I might say likely there, Mozambique, that's not how you spell Mozambique, was already poor in terms of exports given its weak manufacturing. You don't need two, I'm just giving you two options. I like the first one better here. I think it's a bit more analytical. The judgment here is just going to be to say that high inflation rate is damaging to economic development because it limits business profits and thus investment, and it reduces export competitiveness. The result is decreasing exports and decreasing domestic demand, which may only be offset somewhat by falling currency values, restoring some level of price competitiveness. So really trying to sort of bring this together and give us a whole picture, which is probably this is really bad for economic development. You could also talk about that government debt. You might even be willing to talk about how inflation might end up reducing to some extent that debt burden. That might be a little bit of a controversial argument, but I'm pretty happy with what we've written here. I think if anything, we've written way more than we need to, but hopefully that's given you lots of ideas about what you could write about for this essay.